Greg, it is indeed always great to see you.
It's great to see you too, Jim. Thank you for having us.
All right, you're splitting the company into 3 parts, but let's just go over this. In 2002, in your annual report, we read that the aerospace business declined, but it was saved by Carrier and Otis.
Yeah.
In 2005, in Chief Executive Magazine, 2 CEOs ago said the secret to the company is the balance of the business. In 2007, when housing went down and Carrier went down, aerospace, your CEO said, is what saved you. If we have this tremendous conglomerate that has always had a higher PE than the rest of the market, why would we ever break it up?
Because it's the right thing to do, Jim. Look, I mean, we can go back and look at any one point in history and say, the commercial businesses outperform the aero business. And over time, we always said balance works at UTC. I would tell you, as I've gone out and spoken to all of our investors over the last year, there is almost unanimity that the businesses would perform better as separate, focused businesses. And frankly, we don't get paid for the diversity and for the benefit of consistent earnings the way we did 10 years ago. What the investors have told us is, let us diversify. If we want to buy an aero stock, we'll buy an aero stock, right? If we want to buy a commercial HVAC business, we'll buy commercial HVAC. But UTX, because we are so big, and I would tell you complicated because of the different markets that we operate in, different cycles that our businesses go through, it just will be so much simpler for people to think about what is the story around Otis Elevator and the 2 million elevators that we service every day around the world, right? What about the Carrier business, right? Over 100 million air conditioners installed in the U.S. We're going to service those. We're going to replace those over the next 10 years. Phenomenal growth. And the aerospace business standalone today with Rockwell, $50 billion in revenue. So there's no weak sister here. This is not a spin to get rid of something that doesn't fit, doesn't belong. We're doing this because we think it's the right thing for our employees, for our customers, and for the share owners.
Okay, now, earlier this year, several times you thought this deal with Rockwell Collins was going to close earlier. There were issues with China. What happened with China to greenlight this? Because it could be very important for relations between our country and China.
Yeah, let's be clear. The Chinese had always told us that they were not going to approve the deal until the DOJ approved the deal. They wanted to make sure that the conditions that we had signed up for in China were the same as the conditions that we signed up for with DOJ and the EU. The DOJ approval did not happen, unfortunately, until the 1st of October. That forced, with the holidays in China, we actually didn't notify the Chinese until the 8th of October. They said the process will take 4 to 8 weeks. And in fact, we had about a week left, but they had told us all along, this is going to happen. There was no political issue here. This was simply a process issue. And SAMR, which is the new agency responsible in China, MOFCOM used to be the approval authority, now it's SAMR. Very professional, very forthright, and again, no political agenda.
Which you were confident on the conference call a few weeks back, and
we said
that
between 2 and 6 weeks. It took about 5.
It was well placed.
I don't think everybody believed me, but.
Well, you were, and you also gave us, more or less gave us a roadmap that this would be coming, although not quite as soon. But I'd love to understand, Greg, your evolution and that of the board in terms of this being the right strategy. Back to Jim's sort of question, and to your point that we don't get paid anymore for being sort of a diversified conglomerate. Was there a moment when you finally said, you know what, this is not working, we've got to move in a different direction? Can you give us some sense?
So interestingly, I've been the CEO for 4 years now. And the first thing we did was the hardest thing, and we sold Sikorsky. And Sikorsky was, again, it's a good business, but it's a very long cycle business, but it's 100% defense, and really didn't fit in with where we wanted the business to go. It didn't have the growth, and it had high risk in some of the programs. So remember, we did that back in 2015, in March. The fallacy or the learning for us and for the board, I think, during this process, and we studied 74 different spin transactions that have occurred in the last 10 years. And what we looked at was, what are the cash flows of the business over time, and can the businesses support themselves with the cash flows in order to make enough investments to sustain growth? And the fallacy in our thinking was that you needed cash flows from Otis and Carrier to pay for the investments in Pratt & Whitney and the aerospace systems business, right? You're going to build a $10 billion engine, you need cash coming from Otis and Carrier. The fact is, when we looked over the last 10 and 15 years, the cash flows from the aerospace business more than covered all of the R&D, all of the CapEx, and their share of the dividend. So there was no cross-subsidy required. And it was, I think that was the magic moment when the board said, we don't really need to be together. Then the question is, should we be together? And again, as we started looking at the other spins, these 74 spins that have occurred, what we saw is a high preponderance, 80+% of these businesses that you spin off do better in the 3 to 5 year period after the spin than they were doing pre-spin. And I attribute it to one thing, and that's focus. Right? You know, we can talk about capital structure and capital allocation and different investor base, but I think the focus of a management team on that business is what will drive the results.
So what's the argument now for the modern conglomerate? What's left?
Well, I guess you'd have to talk to Mr. Buffett about that.
or Mr. Culp.
Or Mr. Culp. But look, Larry's going through the same process, I think. And GE, different animal than UTC, right? Much more complicated, had a financing arm, things that we don't have. So our split here is actually quite simple, complex in the tax restructuring, but in terms of separating, we already have 3 businesses that run by themselves. Our goal now is just to set up 3 public company headquarters to support those businesses.
Greg, it's going to cost a bit more than some had anticipated. I think that's why the stock is looking down in the open. You say between $2.5 and $3 billion in one-time costs. Can you run us through why that number is seemingly larger than some had anticipated?
So you break it down, there's 3 pieces of that cost. There's about $500 million, I would say, in true one-time cost, and that is to set up the IT and tax structures to run the business. So today we've got a single IT structure for all of UTC. You got to replicate that 3 times. One treasury system, replicate that tax system. So a huge amount of IT investment. The second big piece is tax restructuring. We've got about 1,200 legal entities around the world. We've been optimizing the tax structure to minimize taxes globally. Well, all of a sudden, you've got to restructure each one of those 1,200 entities and break it up between Carrier, Otis, and UTX. So that's going to take a long time, about 18 months, and that is probably $2 billion of cost.
Wow.
There are transfer taxes to be paid in almost every jurisdiction. Okay. Now, the reason it's going to take us 18 to 24 months is we're trying to minimize that cost, and I hope when we're all said and done it's lower. But we didn't want to surprise anybody and come back and say, hey, there's another $500 million here. So tried to be conservative in the upfront.
Kinley, Ed Breen is saying that the costs did come in lower for Dow DuPont. I have to believe that you'll be able, given your bean counter history, do better than that.
Look, under promise, over deliver.
DuPont.
That's it.
Let me ask you something, because I think that you're probably a person who can answer this with boots on the ground. You're a huge buyer of some of the materials that have tariffs on them.
Sure.
How's it working for America? How's it working for us?
So look, I have been clear about this issue on tariffs for the last couple of years, and tariffs benefit no one, right? We're going to spend $150 million in the coming year to pay for these additional tariffs. Ultimately, tariffs become a tax on consumers, right? We've raised prices 3 times at Carrier this year to cover the tariff costs that were coming in. Tariffs don't bring jobs back. Tariffs don't accomplish what we're trying to supposedly accomplish.
But what does, Greg? What leverage do we have over the Chinese, the Belt and Road Initiative, the 2025 destruction of American hegemony? What do we have?
Jim, look, we are a multinational company. We've got 26,000 employees in China. We manufacture in China for the Chinese market. We manufacture in Europe for the European market, in the U.S. for the U.S. market. And for the aerospace business, we operate globally. Right? China will take 1 out of every 4 aircraft that's built in the world this year. Right? China is an important part of the world economy. We have to figure out a way to deal with the Chinese. I'm not a politician. I'm not going to get into that debate, how best to do that. I will just tell you my own view, and we've seen this before, is tariffs don't work. And if the idea is to bring jobs back, it ain't going to work.
Are you worried about your business then, given the prospect of 25% from 10% in the not too distant future?
Well, look, do I worry about tariffs? Do I worry about that? Of course. I think, you can only raise prices so much before you impinge on demand. You also create inflation in the economy, all those things that we try and avoid doing. I think trying to find a rational, reasonable solution is imperative here in the near term.
Really quick, whether it's tariffs or cost inflation or rates, is the buyback picture changing overall in corporate America?
Look, there's lots of cash out there, right? Tax reform has freed up a ton of cash. We brought back more than $5 billion this year. We're using cash to deleverage. Many other companies are using it to buy back their stock. I think, the valuations, while they look heady today, as I look forward, earnings are going to continue to grow in all 3 of our businesses for the next 3 to 5 years at a pretty good clip. So I think as we think about valuation, there's still opportunities to buy back stock.
Greg, back to the spins themselves. That is the plan now, but is there a possibility that you could participate perhaps in M&A via one of the spins, and or there's some talk that your fire and security business in Carrier, for example, could be attractive? Would you sell something out of one of the divisions?
So a couple of points there, David. First of all, on the Carrier side, we are in a process of looking at our fire and security field business. It's about $2.5 billion. It's a low-tech business, about a 10% margin business, but not an innovation business, not a product-driven business. So we've been talking about a potential divestiture there. As far as M&A goes, I would just go back to the Sikorsky playbook. We announced the spin in March, and 3 months later we announced the sale to Lockheed Martin. If somebody comes forward with a compelling offer, we'll certainly listen. I think the hard part for both Carrier and for Otis Elevator is that the markets are relatively concentrated, and antitrust risk is tough.
Right.
Having just gone through a 14-month process for a very, what we thought was a straightforward combination, I think you have to go in eyes wide open in terms of what the risk profile is.
Greg, last question before I let you go. Let's say Jay Powell's pretty sanguine about the economy. He's talking about December rate hike, maybe 3 more next year. Any impact on the U.S. economy? Are we humming so strong we don't have to worry about those rate hikes?
Look, there's full employment in the U.S. My fear is not rate hikes, right? We'll spend $1 billion in interest expense next year on $10 billion of EBIT. It's just not that big of a deal for us, but I am concerned with full employment that there is inflation on the horizon. You know, we've got 5,000 job openings today. We're trying to hire 35,000 people here in the next 5 years. It's tough to do. So I think there is a inflation in the background, and I think labor will lead the way if we can't figure out a way to solve that.
Wow. CEO of and Chairman of United Technologies coming out for more rate hikes, but less tariff.
Pick your poison.
Yeah. Thank you, Greg Hayes. Hey, congratulations on the deal. And the stock is down 3, which I would say buy.
Thank you so much, gentlemen.
Yeah.
Appreciate it.
Thanks, Greg.